Have you ever pondered over the idea of investing or trading in the stock market but felt overwhelmed by its complexity? If so, you're not alone. The world of stocks is indeed a vast and intricate landscape, filled with peaks of profit and valleys of volatility. But fear not, for the complexity of this world is what makes it so intriguing and potentially so profitable. The stock market is essentially a public market for trading company shares. It's a place where companies raise capital and investors can potentially reap rewards. But it's not a casino. It's a platform that requires knowledge, patience, and strategy. And that's precisely what this video aims to deliver. Our journey into the intriguing world of stocks will begin by exploring the foundational concepts of investing and trading. We'll delve into the strategies that seasoned investors use and the mindset that's required to navigate this world successfully. We'll discuss the potential of stocks as a profitable avenue for investment and the risks that come along with it. After all, investing in the stock market isn't just about buying low and selling high. It's about understanding the market dynamics, the financial health of companies, and the global economic landscape. It's about making informed decisions and not being swayed by emotions or market hype. So why should you consider investing or trading in the stock market? Well, the answer is simple: potential. The potential for growth, the potential for financial independence, and the potential to create a more secure future. But remember, with great potential comes great responsibility. It's essential to approach the stock market with a clear mind, a solid plan, and a willingness to learn. And that's where this video comes in. Consider this your guide, your roadmap to understanding the process of investing and trading in the stock market. We'll cover everything from long-term financial investing to smart trading techniques, providing you with the knowledge and tools you need to navigate this intriguing world. So, are you ready to embark on this journey? Are you ready to decode the secrets of the stock market? If so, let's get started. Let's embark on this journey to decode the secrets of the stock market. Imagine owning a piece of a company you believe in and sharing in their profits. That's what buying and holding stocks can offer. Now, the buy and hold strategy is quite straightforward. You buy stocks in a company and hold them for a long period, often years or even decades. The idea is to allow your investments to compound and grow over time. It's like planting a seed and patiently waiting for it to grow into a tree. But the beauty of this strategy isn't just in the potential for growth, it's also in the dividends. Dividends are a portion of a company's profits shared out to the stockholders. Think of it as a thank you from the company for investing in them. Now, when it comes to dividends, timing is everything. Some companies pay out dividends monthly, but more often than not, companies distribute dividends on a quarterly basis. This means you could be getting a little thank you note in the form of a dividend every 3 months. But why are dividends so important? Well, they provide an income stream in addition to the potential growth of the stock's price. So even if the stock price stays the same, as long as the company is profitable and continues to pay dividends, you're still making money. Plus, dividends are a sign of a company's financial health. A company that regularly pays dividends is likely in good shape. It's like a seal of approval. They're saying, we're doing well, and we're sharing our success with you. And here's the kicker. Dividends can also be reinvested to buy more shares in the company. This allows your investment to grow even more over time, creating a snowball effect. It's a win-win situation. So buying and holding dividend-paying stocks could be a lucrative strategy for long-term investors. You're not just betting on the company's success, you're also sharing in it. And with patience and discipline, this strategy could lead to significant financial growth. So why not take a piece of that pie for yourself? What if you could use your dividends to buy more shares automatically without lifting a finger? Well, that's exactly what the Dividend Reinvestment Plan, or DRIP, is all about. It's a bit like magic, really. But instead of pulling rabbits out of hats, we're pulling more shares out of dividends. So how does the DRIP work? It's pretty straightforward. When a company you've invested in pays out dividends, instead of receiving those dividends as cash, they're used to purchase more shares of that very company. The best part? This process is automatic. You don't have to keep track or manually reinvest each time. Now you might be wondering, what's the point? Why not just collect the dividends as cash? Well, here's the magic of the DRIP. By reinvesting your dividends, you're essentially buying more shares without spending any additional money from your pocket. This leads to owning more shares, which in turn leads to receiving larger dividend payouts, thereby allowing you to buy even more shares. It's a cycle that can help your investment grow exponentially over time. But the charm of the DRIP doesn't stop there. It's particularly beneficial for long-term investors. Why, you ask? Well, one of the secrets to successful long-term investing is the power of compounding, the process where your earnings generate even more earnings. By reinvesting your dividends, you're putting compounding into action, allowing your money to work harder and potentially grow faster. Also, DRIPs often come with the added benefit of no commission fees for the additional shares purchased. This makes it a cost-effective way of expanding your investment. But remember, DRIP isn't a one-size-fits-all strategy. While it can be a great tool for long-term growth, it might not be the best fit if you rely on dividend income for immediate cash needs. So, there you have it. The DRIP is a smart way to maximize your returns and grow your investments over time. It's like having a magic wand that works tirelessly to expand your share count and potentially increase your wealth. Now, who wouldn't want that kind of magic? What if you could invest in multiple stocks at once without having to research and choose each one individually? Sounds like a dream, right? Well, exchange-traded funds, commonly known as ETFs, make this possible. Let's break it down. An ETF is a type of fund that holds multiple underlying assets, not just one like a stock. So when you buy shares in an ETF, you're essentially buying a piece of a broad portfolio of assets. These assets could be stocks, bonds, commodities, or a mix of all these. It's like having a mini portfolio in one single share. One of the major benefits of ETFs is diversification. By owning an ETF, you're spreading your investments across a wide range of assets. This can help reduce your risk. Think of it as not putting all your eggs in one basket. If one stock in the ETF underperforms, it might be balanced out by another stock that's doing well. Another advantage is the potential for higher returns. Some ETFs are designed to track the performance of a specific market index, like the S&P 500. If the index does well, so does your ETF. Additionally, ETFs are traded on the stock exchange, just like individual stocks. This means you can buy and sell them throughout the day at fluctuating prices, offering flexibility and liquidity. And there's more. ETFs often have lower expense ratios than mutual funds. This is because most ETFs are passively managed, aiming to mimic the performance of an index rather than trying to beat the market. Lower costs mean more of your money goes towards your investment, which over time can make a significant difference in your returns. But remember, while ETFs offer numerous benefits, they're not immune to risk. The value of an ETF can go down as well as up, just like any other investment. ETFs could be a cost-efficient and effective way to invest in the stock market, especially for beginners. They offer a way to diversify your portfolio, potentially increase returns, and keep costs low, all without the need to pick and monitor individual stocks. Now that's the power of ETFs. Did you know there are stocks that don't pay dividends but can still make you money? Yes, you heard right. In the investment world, not all stocks pay dividends. These are companies that choose to reinvest their profits back into the business for growth, instead of distributing them to shareholders. So you may wonder, how do these non-dividend paying stocks make money for investors? The answer is through capital appreciation. Capital appreciation is the increase in the value of an asset over time. So if you buy a stock at $10 and it goes up to $15, you've made a profit of $5 per share. This is how non-dividend paying stocks can still be profitable. They might not give you a steady income stream like dividends, but they have the potential for substantial growth. Now let's add another layer to this. What if I told you these non-dividend paying stocks could also be part of exchange-traded funds or ETFs that do pay dividends? That's right. You could potentially hit the investment jackpot with these kinds of ETFs. Here's how it works. ETFs are investment funds traded on stock exchanges, much like individual stocks. They hold assets such as stocks, bonds, or commodities. Some ETFs focus on dividend-paying stocks, while others might include a mix of both dividend and non-dividend paying stocks. So imagine an ETF that includes a non-dividend paying stock you're interested in, but the ETF itself pays dividends. You could benefit from the appreciation of the non-dividend paying stock, while also receiving dividends from the other assets within the ETF. It's like having your cake and eating it too. Of course, it's essential to do your due diligence before investing. Research the stocks and ETFs you're interested in, understand their performance history, and consider their future growth potential. And remember, all investing involves risk, and past performance is not indicative of future results. Investing in non-dividend paying stocks can be rewarding, especially when they are part of dividend-paying ETFs. So don't discount these stocks just because they don't pay dividends. They might just be the hidden gems you've been looking for in your investment journey. Now that you know what to invest in, let's talk about how to get started. The first step to begin your investing journey is to open a brokerage account. This account is your gateway to the stock market, allowing you to buy and sell shares of companies, ETFs, and other investment products. There are a plethora of brokerage firms out there, each offering different features and benefits. Some of the notable ones include TD Ameritrade, Webull, and Robinhood, but remember, these are just a few examples. Feel free to explore and choose a firm that best suits your investing style and needs. Once you've chosen a brokerage firm, the process of opening an account is usually straightforward. Most firms have an online application process that requires you to provide some personal information and financial details. It's a good idea to have your social security number, employment information, and bank details handy when you're ready to apply. After your account is set up, it's time to choose a company to invest in. This is where your research skills come into play. Look for companies or ETFs that align with your investing goals. Are you interested in long-term growth? Then maybe consider companies or ETFs that have a history of steady growth and pay dividends. Or perhaps you're more interested in a short-term investment strategy. In that case, you might want to look at companies with high volatility. Remember, investing is not a one-size-fits-all endeavor. What works for one person might not work for another. So take your time, do your research, and make informed decisions. And don't forget, you can always consult with a financial advisor if you're unsure or need further guidance. With your brokerage account set up, you're now ready to step into the world of investing. Remember, the journey of 1,000 miles begins with a single step. So take that step, start investing, and let your money work for you. Happy investing. Want to know a secret of buying stocks at a discount or selling them at a premium? It's all about the art of limit orders. A limit order is a tool that allows you to set the price at which you want to buy or sell a stock. This means you can buy a stock at a lower price than its current market value or sell it at a higher price. Let's break it down. Suppose you're eyeing a stock that's currently trading at $50 per share, but you believe it's worth $45. With a limit order, you can set your purchase price at $45. If the stock price drops to or below your set limit, your order is executed. You've just bought the stock at a discount. But what if the stock price never drops to $45? This is where the good till canceled, or GTC feature, comes into play. By setting your limit order as GTC, your order remains active until it's executed, or until you choose to cancel it. This way, you're not bound by the daily fluctuations of the market. Your order stays put until your desired price is met, even if it takes days or weeks. And guess what? Limit orders work the same way for selling stocks too. If you own a stock trading at $50 but believe it's worth $55, set a limit order to sell at $55. When the stock price hits or exceeds your limit, your shares are sold at a premium. But remember, while limit orders give you control over the price, they don't guarantee execution. If the stock price doesn't hit your set limit, your order won't be executed. So it's a balance between getting the price you want and ensuring your order is filled. With these smart trading techniques, you can maximize your returns and minimize your losses in the stock market. So, are you ready to dive into the fascinating world of stocks? It's been quite a ride, hasn't it? We've journeyed through the intriguing landscape of long-term financial investing and marveled at the wonders of dividends, the magic of dividend reinvestment plans, or DRIP. We've discovered the power of exchange-traded funds, ETFs, a cost-efficient way to invest in the market. We've also explored non-dividend paying stocks and how they too can be part of a profitable investment strategy. And let's not forget the smart trading techniques we've discussed, like using limit orders to buy shares at a discount. In essence, we've unraveled the complexities of the stock market, making it accessible to you, the budding investor. Remember, this is just the beginning. There's a whole world of investment to explore. Remember, investing in the stock market is a journey, and every journey begins with a single step. Take that step today and start building your wealth for tomorrow.